everybody. It's a pleasure to be with you today. I'm thrilled to be joining you. Of course, there's never been a more dynamic time for branded residences around the world, and I'm really honored to be joined here. And why don't you guys come up on stage? And I'll have you introduce yourselves in just a moment here. We have a great point of view here from developers, from brands, from operations people, from the legal realm, and from sales and marketing. And of course, these challenges, as branded residences grows as a sector, create all kinds of new contextual issues for us. So I'll start with Robbie. Robbie, why don't you work your way down the line here, and we'll spend a minute and introduce yourself. And
Hi, how are you, everyone? I'm very glad to be here. We're actually a family office based in Abu Dhabi. We have a real estate arm, and what's keeping us busy nowadays is the branded residence. And we will talk about it. One of our projects that we just launched is a Four Seasons on Saadiyat Island. I can see our partner, Sean Killa, which designed it. We have another 6 projects in the pipeline, all branded standalone. Thank you.
Great. Sophia?
Hi, thank you so much for having me. I'm a practicing attorney for the last 16 years, and I represent a lot of high net worth clients who are investing through developmental agreements with clients here in the UAE. I sit on the board of directors for a South African law firm, Thomson Wilkes, and I am the CEO of Fortunatus Advisory, a incorporation and business advisory here in the UAE.
Great, wonderful. George?
Hello, my name is George Azar. I'm the chairman of Sotheby's in the UAE, Saudi, and the UK. We work mainly on many products, mainly on the luxury side. The branded fits within that bucket, so we'll tell you more about it when the time comes.
Daniel?
Really awkward introducing Accor after everything that we've just seen. But I'll summarize it simply by saying I look after development for our branded residences projects globally. And we have every year, we help our development partners sell approximately $2 billion of residential real estate under 26 different brands.
It's incredible. So, you know, the opportunities that we've all been hearing about, as Rian just described, as Jeff described, have never been greater, because, you know, this is, as much branded residential development activity has happened around the globe, it's still incredibly early, right? I mean, so I think we all work in markets that are just emerging. I do work in Texas, and Texas is woefully underserved with super luxury residential offerings, let alone branded residential. And so there are all kinds of emerging markets around the world, but of course they're crowded markets. And what happens as we have more and more choices of brands, all of the brands that we all work with have been expanding, have been introducing new luxury goods brands, new hospitality brands. Companies like Accor, Hilton, Marriott have all been investing in new brands. We've never had a greater selection from which to choose for branded residential. But of course that creates new challenges, right? There's never been a riskier time to introduce a branded residential project, because of the fact that you've got to get it right in order to resonate with the market. And it's not just about the marketing period, it's about the staying power, it's about the sustainable value proposition for buyers. And so what we're here to talk about today is mitigating that risk by investing in the right partnerships, investing in the right marketing scheme, in setting up your condominium declarations and the legal agreements between the brand, the developer, property management, the capital stack, that really make these types of projects successful. And so with opportunity comes risk, and we're here to mitigate it. So Robbie, you know, you as a developer, I know you're investing in significant new standalone projects. You know, branded residential is also a great vehicle to attract capital, not just attract buyers because they like the brand, they think you've got a great reputation as a developer, but let's talk a little bit about your more recent experience attracting capital, these types of projects, and the issues that you're facing now as you expand with your new development opportunities.
Yeah. Thank you. Basically, in my mind, an investor, developer, a brand, or a buyer, they are investor. And nowadays, smart capital, they are focusing not only on making returns, but most essentially into protecting their returns, like you mentioned, especially in a volatile market. So again, investor, they want to make income and returns, but they want to protect it. And this is where the branded residence play a key role. We believe, as a developer, we create the value for our investors. But we also believe strongly that the right brand is here to protect the value created. Because I heard previously about brand, non-branded hotel. In my mind, it's not only about the brand, it's about, when you say hotel, it's about the operator who operates this asset. End user or investor, for them, this is very essential, because if they are an investor, they want to make sure that their money, their asset, is well managed. If they are an end user, they want to make sure every morning they don't have only a security, they have someone who open the door for them and smile and tell them, "Good morning, Mr. Peter. Nice to see you today. I hope everything is well. How can I help you?" Thank you.
And George, of course, that makes it easier to sell when
I
these
mean,
projects
listen,
are
I mean,
well run.
I'm working
right?
for him, so I can tell you a bit more about that. He's not an easy client. So, having said that, I mean, for me, I mean, listen, I used to be a banker. So when the internet bubble occurred, you had everybody putting money in the internet, right? And then in 2001, you had the burst. I think the branded residence, now you have almost 650 brands globally, it's gonna get to 1,000. Eventually, these brands have to offer something. I'm not gonna name things here because I'm the most controversial person probably in the room, but many brands, in 2 years, you have to see what's the value of the property. What kind of services have they done? How is it maintained? What are the services? What's the resale value? Who are the tenant? Who are the landlord? So for us, when you have a brand like the one they're selling without naming people right now, when you command such a high premium, which is 30 to 40% above normal rates, it's purely based on the brand, location, and the architect,
Yeah.
and the finishes. It's a combination. It's a puzzle. It's not only the brand. I mean, the brands are great to operate, but the brand that doesn't operate, for me, what is it for?
That's right.
Okay, so for my mythology is sustainability of that product.
Yes.
The only way you can sustain it is by, having an operator in there. So most of today, if a brand commands, I don't know, 30, 40%, like the one we're working with Rabia on, you bring me another brand that commands an 8% premium. It's not worth it. Your costs are going to be 3%. For a 5% premium, invest it in your architect, in your finishes, in your quality. You're better off, having something that makes sense. Because God knows what this brand, will it continue in that branded residence? Now all of them are coming in. It's like tomorrow you have Patek Philippe, getting into that. It's impossible.
That's right.
Or tomorrow you have, I don't know, the other way around. You have Ritz-Carlton making watches. This doesn't add up. So.
Yeah, but also investing in the marketing to tell that story. I mean, weaving the tale around what that value proposition is for buyers becomes more important. And so if you have a less recognized brand, there's less power there, there's less marketing power.
We've sold a lot of branded here in Saudi, right? A lot. So we know exactly what is sustainable and what is not sustainable.
Yes.
My job is to focus on what protects my company, my brand, my developers, by advise them what I think. Eventually, it's their call. But I bring in that value proposition, which up to them to decide. I mean, I'll give you a small example, if I can, in a few minutes. We have there a gentleman called Hunter Milbourne. This gentleman in Canada sold over 1,000 towers, 170,000 unit off plan. He's one of the biggest real estate guy globally. So he took on, through Sotheby's, Canada, the Four Seasons in Toronto in 2008, right after the crisis. The prices in 2008 on normal stuff, I mean, branded, were trading around $800 a foot. In 2008 till 2007, he sold it at $1,250. So the brand, the Four Seasons, played a major role in that market because the same buyer.
That's right.
So brand do help in crisis. Today it's a wave, we're all riding it. Tomorrow, God forbid, there is a downturn, only the top brands will be able to still command premium.
You know, it's an interesting point, and Daniel, I want to ask you about this because coming back to the capitalization of these projects, sometimes when the stakes are higher, the total capitalization of a development could be $1 billion US, you know, depending upon the scale. Having a brand partner that really knows what they're doing matters a lot, and we'll get into operational issues later, but one of the things that always impresses me about some of the most marketable brands in the world that have a reputation for running these projects really well, supporting technical services, supporting marketing, is that they bring capital with them to developers. So when you align with a brand like Accor, oftentimes Accor or Marriott or others will actually arrange for the investors that invest not only in you, but in what they do. And so, Daniel, maybe you can talk a little bit about the reputation building that you've invested in to have that kind of symbiotic relationship with the developers in the capital markets.
Sure, Peter. I think firstly, we certainly have, we look after close to 6,000 hotels around the world. And these are properties which are worth anywhere from, say, 100 million to well over $1 billion in terms of real estate. And so what we do for our owners there translates into what we do for our residence owners. We fundamentally are looking after maintaining and enhancing the asset value of these properties. And these investors, these owners, they trust us with future hotels. And therefore, when we're looking at projects which have a hotel component and a residential component, they very much trust us. And we come to them and we say, hey, we've got an opportunity that we think you might be interested in. And what's also interesting is looking over the last 20 years at, from an investor perspective and a capital stack perspective, lenders have now understood branded residential. When I think back to conversations I remember Rianne and I had when we were working together, and you'd go and see a lot of private equity, banks, etc. For starters, banks have the hotel lending team, they have the residential lending team. The hotel lending team do not understand, or now they begin to, how to underwrite residential. The residential team can't touch hospitality. And as a developer who's developing a project where, let's face it, 70% of luxury hotels in the pipeline include a branded residential component. So the ability of underwriting the resi as well as the hotel is fundamental to the cap stack.
That's right.
Now, the lenders are able to do that. Private equity, there's a lot of private equity around now that understands residential. Some are even looking at sort of setting up funds specifically focused on branded residential.
Right.
Some of those are our owners, couple in the room. So it's very, very much developed and it continues to mature.
And I think also, oftentimes the capital markets invest in projects that are geographically diverse. So you could have the same capital investor investing in a project in the Bahamas or in Dubai or in Miami. And what those players bring to the table then is a pretty broad level of familiarity with how these deals work. Not only what the marketable aspects of them are, but also what the risks are. And so I think that familiarity really can help quite a bit. The deal structure, though, matters a lot. How you structure these legal agreements, not only in terms of how the building will operate, but actually how you strike the right relationship legally, on paper, the relationship between the brand, the investors, and the developers. Sophia, maybe you can talk a little bit about your experience getting that right.
Yeah, I think that is wholly important and integral to the investors, is that we see that there's a structure that's created that protects the brand, and that essentially the brands want to protect their IP, their brand registration, within country. Of course, each country differs and has different rules and regulations, and specifically between here in the UAE, Saudi Arabia, where we're looking at a massive growth in brand, and with our investors looking at that, we want to be assured that those brands actually have the correct IP licensing in country. And then, of course, the agreements between the developer and the brand. So from the developer point of view is to ensure that those brands are there with the developer, and the brand has tenure with the developer. So not something that's going to last for 5 or 10 years, but we're looking at something that, because the units are selling at a premium, we want to see a 20 to 30-year tenure that is automatically renewable. And that gives assurances to our investors that, well, at the end of the day, they're buying real estate. So at the premium end, with a brand. So we want to see that, why does it warrant that premium pricing? Is the tenure there? And then we're having a look at, for our investors, a complete and thorough legal due diligence. there's been a shift away from, naturally, all of these transactions are dealt through special purpose vehicles. There's been a shift away from BVI or Cayman, which is great news for the UAE, and incorporation into the ADGM or the DIFC, and then also termination clauses, which are hugely important and integral to the agreements. We're looking at jurisdictions in DIFC, arbitration clauses, ADGM, and utilizing common law, which gives also investor confidence between the brand, the investor, and the developer. And as much as the developer looks to ring fence their interests and their liabilities, our investors are looking to secure their capital growth and the preferential return of capital for their investments. So for the investors, it's hugely important to go through absolutely every single agreement, and there's multiplicity of agreements, and I'm sure, like Ravi, you're probably going through the same structure. It's the subscription agreement, the ascension agreement, the articles of association, and a myriad of other agreements, including the brand licensing, the tenure, and all of these need to conform in some way. And for us, and for me and for my clients, the most important thing is that our investors' interests are protected, and as much as we can. So a thorough legal due diligence from our perspective would incorporate, does the developer have authority to utilize the brand? Is the brand protected? How is the brand protected? Is there clauses protecting infringement rights, things like that? What are the penalties? Is the property registered? Who owns the land? Who owns who's controlling the development? Who are the people behind these companies?
That's right.
Because essentially that's hugely important. Do we know the people? And in a city like Dubai or the UAE, you're dealing with 144 different nationalities. And I loved listening earlier is that in the room, people are talking of where they grew up in Canada and holidaying together and being in the same area. And I grew up in an environment where you'd pick up a call and every single business entrepreneur knows everybody, irrespective of nationality, religions. You could get a really good reference on anybody you wanted. Coming into the Middle East, it's a bit more tricky. There's languages at play, there is nationalities at play. Who are the people controlling the interest, and how comfortable are our investors with those controlling bodies?
And that rigor, of course, protects your investor clients, but also it protects the buyers. And so when these buyers are coming into a project that has that level of legal advocacy, it's important, especially when I understand, especially in the UAE, that the laws are changing. They're evolving quite a bit as it relates to owners associations, and perhaps there's some issues around that are providing even greater security for the buyers and the investors.
Yeah, so for end user, the owner association and the RERA authority is fairly new. There's new regulations coming out, and I think the owners association became more regulated around 2019 in Dubai. And that was really streamlining owners associations within the country and within Dubai specifically, and having either the developer part of the owners association or management agent part of it, and also having the interest from the RERA authority and government organization to ensure that the maintenance of common areas are done according to a specific standard. And I think that's hugely important for the end user, and in terms of maintaining a big brand, that's hugely important that these regulations are in place. Yes, the Middle East is still developing in terms of that. It's not as old as maybe the UK or the US or France, but it is at the forefront of the government authorities, and it is being dealt with. So there are changes continuously, and I think for any investor, brand developer, it's important to have a legal team that's looking at each different aspect, because there's a myriad of considerations to take into.
For sure, and what we're really talking about is trust. At the end of the day, if the market trusts the team that you've put together, the rigor of the documentation, the risk mitigation involved, of course it bolsters not only that deal, but also your future opportunities. And so, Daniel, when you're looking at, these types of deals, what's your approach when you're approached by a developer on a site and they're, pitching you to come into the deal? How do you approach thinking of bringing in a core brand into a site? What are sort of the first check the box items for you?
So the first one we look at is to pick up on the point we just discussed is it a location or jurisdiction where the legal framework is able to support branded residential, certainly hospitality branded residential? Do you have body corporates? Typically, if you do have one, is the HOA able to terminate the residential management agreement every single year? It's a simple majority vote. So, how secure can we be if we bring a brand into a property that the brand can be there for an extended period of time? So there's a lot of legal due diligence that we look into, and that allows us to then start having a discussion with a development partner about structuring it in such a way that the promise that is ultimately made to the buyer, that we are responsible to the buyer to then being able to deliver, can be delivered, so that we protect the interests of the buyer. In doing so, we protect our own reputation. Then we get into the sort of more specific analysis of, well, let's find out together through third-party research about the buyer profile, the psychographic, the demographic, the nationalities. How are they going to use their properties? Why are they going to buy these properties? Are they predominantly more lifestyle driven, or is this more classic? Are they in their mid-20s to mid-40s, in which case we need more kids clubs? Or are they more sort of in their 50s, 60s, in which case we need to be thinking more about teens rooms, games rooms, some of the other amenities that we looked at earlier. So that allows us to understand who we're designing for. And then we get into the next level, which is talking about the product itself, not just the residential amenities and the extent of those. In where we have those discussions, we're simultaneously thinking about what is needed in order to make it as sexy as possible when George is going to present it to buyers. But the other thing that George is going to get asked every single time is, what's the service charge?
That's right.
So we think very carefully about two aspects. One, which dedicated residential amenities are the ones that we need to have to successfully sell and operate this? But two, how are we going to staff this in such a way that we can deliver on the brand promise, deliver on buyers' expectations, but also deliver on service charge so that it is sustainable and competitive within the market. And we do a huge amount of work every single year across all of our residential properties, looking at a corporate level, drilling into service charge budgets, and making sure that they represent value for money for our residence owners. Yeah. And there's always a little bit of a battle, well, not always, I'd say probably about good majority of the time with the developer, around certain cost aspects, and one of the single biggest aspects that drives service charge are utility bills. Utility bills and labor are the two biggest items. How do you also get lower utility bills? Start designing, thinking green from the beginning. These, not only because this will drive down the service charge, and therefore it improves the IRR of the project, but also because this is what buyers are now looking for. For a lot of buyers, particularly younger buyers, they want to know that if they're investing their hard-earned money into a particular property, it is also a property that meets their own values and expectations.
That's right. Even rich people care what it costs to carry these. They want to see the value there every day in the service provision. George, I mean, this leads right into you. I mean, what's the magic combination of these features of brand value, cost of maintenance, et cetera?
So, because I'm a banker, as I said, so I get into the data of the client: land cost, construction cost, potential earnouts. What are you leaving on the table? In a market like the UAE now, with all due respect, developers want to maximize return. My job is to manage their expectation, because at the end of the day, of course, you can potentially sell at the highest price possible, but you still have to, leave some meat on the bone, right? Yes. So that's my biggest fights with all developers. Like, if the numbers don't adapt to me, I just walk off. Yeah. So for me, I'm not there to just sell because I need to sell. If I'm not convinced, I prefer not to do it. So for me, the risks also when I deal with developers to look at how stable financially they are, how much of their own money, are they raising third-party money? Who is the third-party money? If it's a dumb money, smart money. If it's a dumb money, you run away because they've overpromised, they're going to underdeliver, they're probably putting little equity in the deal, it's going to fall off if I don't sell, and I'm going to get blamed. So we know the game, we understand the tricks, so we work with AAA developers, We work with people that we know that well capitalized, and we try to manage their expectation to potentially leave, because eventually when you're a developer, that's not your only development, right? You're going to be doing more and more and more. So if you're going to milk it from the first deal, people won't come back. So the more you leave meat on the table, the more you're going to have a good following of clients. They're going to respect you, especially that these brands, especially the hospitality brands that are involved in this, they have high expectation, and their costs are high, their services are high, and you just have to make sure that all this puzzle works together properly.
That's right. I mean, this comes down to, sometimes great property management, picking the right property management partner. If it's not the brand, sometimes brands don't manage. But, Robbie, how do you think about sort of this execution? Because this is really what we're talking about. 5 years after you purchase, are you still getting the same value out of that investment?
Thank you. This is very essential. This is our philosophy. Basically, the value proposition is what we believe in any deal that we do, not only in the branded residence. Like I've mentioned, we're investor, passive and active investor. In the branded residence, this is where we create the alpha. But in any deal, our philosophy, and especially in this part of the world, is a win-win aspect. In the branded residence, we have the 4 wins that we talked about. The win for the buyer, the win for the brand, the win for the builder, and the win for the overall broader society and community that we work in. We strongly believe branded residence is a good community to be around it. So wherever you have a good project branded, it does not only bring value to the people and the tenant and the buyer of this building, but it brings premium, and George know better than me, to the surrounding plots and surrounded residents. So this is what we focus on before we go into our lawyers and our the governance structure and the documentation. You have to believe in this. Otherwise, it will not work. Otherwise, there will be conflict of interest. People will start thinking each one how want to protect themselves. You have to believe in this ecosystem.
That's right, but you have to invest also in those platforms, and I think there are 2 buckets that are increasingly important in our industry now. One is sales and marketing effectiveness, an actual effective strategy to tell the story, to reach the market, and to really communicate not just in an emotional way, but to educate the buyer related to actually what they can expect for the long term, why they should trust you to purchase in this home. But the other is property management. And so a lot of third-party property management companies don't really understand the brand promise. They're not the brand themselves. They're doing their best. They might white label the management, in fact, but they may not fully understand and embody what the brand means. So Daniel, when you're coming into projects like those that Robbie builds, what is the approach that you want to see to property management that really creates that sort of execution value?
Well, the first thing is that our default position is that we want to also be managing all aspects of residential operations, and that would include overseeing property management, facility management. Now, depending on each jurisdiction, that doesn't mean that we would do it ourselves. There may be certain jurisdictions where, for one reason or another, we don't want to be ourselves contracting to do PM and FM work. That said, we have operating standards that cover every single aspect of operations, and the way the doorman greets the residence owner down to the way in which we handle property management and governance. So what we do is we want to make sure that from our owner partner's perspective, from the very first discussions, we have a very transparent discussion and understanding that we will make sure that even on a franchise basis, our properties are going to be not just built to and designed to, but will be operated to those standards. Because that's fundamental to the promise. For the buyers, at the end of the day, you can have the doorman and the concierge greet you in the most elaborate way possible. You can have the best clean gym possible. If your AC is broken and it's 48 degrees outside in Dubai in the summer, you're not going to care about the way the doorman is greeting you when you go down in the morning. Your brand experience is going to be the fact that your AC is broken and it's been broken for 10 days and no one is coming to fix it. Yeah. So for us, our entire philosophy is based on a holistic approach, the same way we look at our hotels and how we operate our hotels. we look at it from the buyer's perspective. And very often that's something that's overlooked. People think the only thing the operator cares about is the license fee. And this echoes what George said. You have different brands out there. They have different philosophies in terms of what they're looking for. For us, we have two clients during the course of a project. The first time it's the developer, and that's why the developer pays us a fee for the use of our trademark in the marketing and the sale. But our second client for 30 years, 50 years, is the homeowner, because they're paying our residential management fees. So the 8,000 homeowners at the moment and the 35,000 in the pipeline that we look after, they ultimately are our client, to which we have a fiduciary care to make sure their assets are well managed, their service charge is defendable, and that they really feel they are being delivered to day in, day out on the brand promise in exactly the same way. Every one of our million guests that go through a door of one of our hotels every single hour have a certain expectation of what the level of service is that they will receive.
That's right. And as we're wrapping up here, I think that this is ultimately the goal, right? We want buyers that fuel the capitalization of these projects to trust the team, to trust the brand, to trust even the branded residential world that we all work in, that this is going to have value for them that's enduring. And we want them to be repeat customers. A lot of branded residential buyers are collectors. They invest in multiple projects because they really believe in that brand promise. And so much of that has to do with the way it's marketed, but there's got to be truth behind that. So much of that has to do with the way that it's being managed, but that's got to be sustainable. And of course, the legal structure is so critical to get right, because 30 years from now, as that brand licensing agreement or management agreement is expiring, what do? What's the next course of action? And so that all of that risk that we're facing in this sort of new world as branded residential continues to evolve is warranting of the focus. And I'm so appreciative of all of your perspectives today. Thank you very much.
Thank you.